Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Fundamental Bears versus Technical Bulls. It always takes two different opinions to make a market. Right now, we're at a key inflection point. What happens next will likely determine if markets scream higher or sink lower. On the agenda, we'll look at the world economy, company valuations and earnings, and how they're currently differing. We'll then look at the technical analysis and what's happening with price. And then, as always, at the end, we'll explore the investment implications. Today, as always, I want to welcome the co-founder and chief investment officer at Nucleus Wealth, Damien Klassen. Welcome.
Hey, Sam. How you going?
Very good, thanks. How are you going?
Yeah, good.
Good. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. And for those listeners that don't know, Nucleus Wealth is an Australian active and passive investment manager. We're a global macro investment house and use the insights shared in this podcast to construct and manage our active portfolios. We're also the first to offer passive direct indexing in Australia, which has been labelled ETFs 2.0, as you can customize your chosen index with around 50 different ethical, sector and asset class screens that we have on offer across all our active and passive portfolios. Just a quick housekeeping message. If you enjoy our content, please subscribe to our YouTube channel and click on the bell below to be notified when we go live or have a new episode recorded. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So, Damo, you know the script. We've got the formalities out of the way, so I'll pass it over to you to get us started.
Yeah, thanks, Sam. So, I mean, what we wanted to look at this week was, I guess we'd call a disconnect in terms of what we're seeing in terms of market pricing versus what we're seeing in terms of fundamentals. I think there's definitely I don't know if I've ever seen as many people sort of all calling for a recession, and usually it's a bit more widespread in terms of you have some people saying recession, some people not. But whereas now it seems to be a preponderance of economists are all predicting it. But we're getting some quite different price action in terms of markets. I guess what I wanted to do is just sort of delve into that a little bit more and just discuss what some of the where some of the disconnects are and look what are the signs. You're always going to be looking for signs. You can be wrong on both sides, and markets are certainly giving some interesting signals at the moment to. Whereas the fundamentals are still sort of lining up, largely in the same direction. And part of that comes from there's basically three effects you get in terms of markets. If you do go into downturns, you sort of get three effects in terms of why markets fall. And the first effect is interest rates rise, and so therefore there's a relative investment thing between bonds and equities, and there's it increases the discount rate, and so equities come down. And we've pretty much seen all that already. So that was last year's fall in markets as the Fed and all the different central banks raised interest rates. The next one is the earnings side. So the first part affects the valuation, how things are actually valued, what multiple people will pay. The second one is, if there's less earnings, then you see prices come down as well, because markets go from pricing, say, 20 times earnings back to 15 times earnings, which is what we've sort of seen. And then if the next leg is that earnings falls another 10, 15%, well, there's another leg down in the market. And then finally, the third effect is usually once you actually start to see the effects of a recession and you start to see financial crises or other things kick in where companies start going broke. And then you see another leg down in terms of earnings and potentially market sentiment as well, is what you typically see. And so the question is always, how big is each one of these effects going to be, and how important is it? So with that sort of, I guess, intro, I'll sort of lead into to economic indicators, and I spoke about it, saying that that it's most widely predicted recession possibly ever. I've got a chart up of this is from Deutsche Bank, but almost every investment bank out there or economist out there has got some sort of measure, similar measure, whether it be Bloomberg or some of the think tanks and all that type of stuff, all put these ones out where they basically just look at for a bunch of forward indicators and say what do they think the odds of a recession are. And so this one's now saying 80%. And as I said, that's pick your economist. They've almost all got the same type of thing at various levels, just sort of with extremely high risks of recession. Then you dig in and say, well, why is that happening? And the main reason is the composite, leading indicators, which are sort of the surveys that get asked of companies and corporates and individuals. You can sort of add together those types of surveys, and there's some indicators within those surveys that are looking forward at what's going to happen, and they're the least reliable because it's prediction, and so nobody knows for sure with these things. And then you have the backward-looking ones, or the coincident indicators, which is what's happening right now. And so this is just an OECD version. If you look at the G20, we can see here that it's decisively turned down the leading indicators. We've got two other sort of big ones on this graph. One is in 2008, and the other one's in 2020. And so the pattern's looking similar. Where does it bottom out? That's always the key question. But it's certainly a significant downturn in terms of the leading indicators. Then I've got a similar type of chart, but just sort of showing.
So Damo, just on the leading indicators there, what are those leading indicators?
Almost always they're surveys of things like what are your expectations for capex? Are you expecting to hire more people? What do you think of, are your prices? Are you expecting to put prices up, or are you expecting to put prices down in the coming quarter or the coming month? A whole bunch of there's various consumer confidence type ones might go into them, and business confidence as well, in terms of depending upon who's putting these together as to which ones they're going to use. But almost always survey data.
Yeah. Okay. All the key drivers of growth.
So what people call soft economic data, like none of it's when none of it's sort of you can really hang your hat on too much, because some of it might be that 10 small companies all say that things are looking worse, and one large company says things are looking better, and so this survey might make it look like things are terrible because you got 10 to 1 saying bad versus good, but the big company might be so much bigger than all the small ones that the actual economic effect is not there. So that you can take them as a guide. You just can't you can't be sure with the indicators.
Okay.
And so I've got another chart up just sort of showing mixing the leading indicators with the coincident indicators. So you can sort of see that the coincidents are the ones sort of the harder data in terms of what actually has happened right now. And we see that they're still ticking along. They still look all right. Really hasn't turned down at all. It's all been the leading indicators that have turned down.
What are those coincident indicators there?
Similar types of surveys, but it's more about saying what's happened right now. So in the last month, so it might be in the next month, do you expect to put prices up or down? And then in the last month, did you put prices up or down? And in the next month, are you expecting to hire more people? And in the last month, did you hire more people? And so so they're and then you get the harder data again, which is not just survey about did you hire more people, but like the actual payroll data comes out, a month or so after. And that's sort of the better data. And I suppose even later than that, you get all the audited accounts and everything. And so then now you've got a lot more solid view of what's going on. But it's a question, it's a trade-off with all these about the speed of getting this data. If you wait for the solid data, you're going to miss it each time.
Sure. Cool. And so the next chart you've got is
valuation. So we've got so the background is all these economic indicators are looking bad, but the actual real economic activity hasn't really weakened that much yet. Then we look at valuations and we go, look, if you look at all companies as a price to earnings ratio. It's about average in terms of where valuations are. They're roughly at the 20-year average. If you look at it excluding banks, energy, mining, so banks and resources basically, then it's a little bit expensive. It's and that's our sort of preferred measure because the earnings in the banking sector and the mining sector and energy as well can really swing around, and you can get some reads where all other companies might be a little bit expensive, but energy companies might be quite cheap because nobody's expecting the earnings that they earned over the last few years to continue forever. And so so basically valuations are a little bit above average. So you're basically going, okay, going into an economic downturn, but markets are still relatively richly priced, sort of which you typically associate with reasonable earnings expectations.
And Damo, is this for the MSCI World Index? Is that the one you're looking at?
Yeah, that's MSCI. Then we're jumping into what are earnings doing, and I've got these growth forecast lines now. What and there's a whole bunch of little lines running across the chart, all in different colors, and each one of them showing a financial year, or sorry, a calendar year for the US here. So, for example, it's if we're looking at the 2023 numbers, so that's the year we're just going into now. Roughly a year ago, analysts were expecting about 10% growth, and as time's gone on, they've gradually downgraded those numbers, and now they're expecting about 3% growth to come out, or 2.8. And then you can see the different years and how those fall down. And so typically, my I guess the quick way of looking at this is that, look, earnings forecasts usually start at 10% in future years, and then they get upgraded or downgraded one way or the other. I think there's an expectation within the analyst community, and when you look at further years out, I think 10% is a bit of a round figure, and that's roughly where they come to. And then once you actually genuinely start to get close, then you start to see some real movement in these. So and so you can see 2024 is still at sort of 10% growth as well. So there's still, growth rates are still looking, well, they're above zero, and typically into a recession you'd see earnings fall more like 15% or 20%. And so that's our earnings expectations.
So 2023 there, Damien, I can see that the red line, it's trending down. So that when they started that at around about 10%, was that a couple of years ago when that prediction was made, or that forecast was made?
Mid 2021 it started there, and throughout most of 2021 and 2022 it stayed at 10%. It was only sort of in the second half of last year that you started to see downgrades to that.
Yeah.
And we're about to hit reporting season, so in the next 4 weeks, the bulk of US companies will report, and so we'll start to get a much better feel, I think, for those figures. Sure.
The truth will come out.
Yeah, that's right, and we're expecting quite significant downgrades still. So I might jump sort of two charts forward to the US non-PMI leading indicator. Now, basically what this is that there's and this is from Morgan Stanley, but pick your investment bank and they've all got their own version of one of these, is that you can put together some of the different survey data and look at what their weight each category and work out which ones you think are the most important ones, and come up with a model to try and predict earnings based on the survey data. And this one, it's got an R squared of 0.7, which is basically meaning it's about right 70% of the time. You can see on the chart line, it tracks it relatively well in terms of when and actually it's pushed forward 1 year. So basically what it's saying is you push that forward 1 year, and whatever that comes out with a year later, that's the effect you'll see on earnings. Now, this one's expecting 25% downgrades to earnings. I've seen plenty of ones in that same ballpark. So what they're saying, I guess, is that earnings are currently positive, but they're expecting this big drop in terms of the earnings. And so so there is a sort of questions about, well, I spoke about those three measures before. We've got the impact on companies, the impact on valuations from rises in interest rates. Then we've got the cuts as earnings falls, and then finally you've got the a little bit extra in terms of the companies going broke, and bankruptcies and things like that, making a bigger effect on the economy. Now, possibly that time around, we won't see as much this time around. So maybe some of these are overcooking the downside. And the other thing is we have come from quite significant inflation that wasn't seen in prior models of this, and so there's arguments for and against. One argument is that look, inflation's going to fade a little bit more slowly, and so maybe some of these are overdoing it. And there's another argument saying, well, actually, companies really benefited from inflation. Generally, they expanded margins, and so there's a bit of catch up as well. There's a bit of they need to reduce margins to. Or they'll have their margins reduced as costs don't fall away as quickly as what sales and revenues do. So from my perspective, I would say that the earnings side, there's probably another at least 10% more downside in earnings, and then if could you make that 20%? Sure, or 25 if things get worse. But I think we'd certainly pencil in another 10% downgrade, and then sort of trying to work out how deep or how bad the recession is going to be will determine how much further that goes. Now the other one, I've got another chart. The next chart I've got is the same. It's the same chart, except it's just looking at the difference between the two lines. And it's making the point that actually the difference between those two lines is about as deep as it's ever been, the difference. And that last time we saw such big differences, well, in the last 20 years, we've seen two times when there's been such big differences. And in 2001, 2002, the US stock market fell 34% from when it bottomed. And in the 2008, it fell almost 50%. And this measure hasn't bottomed yet. So I guess this is your negative view. This is one of the bigger bears out there. We spoke about him last week in terms of Michael from Morgan Stanley, Michael Hartnett. And so there's certainly you can certainly come up with some pretty dire outcomes for prices sort of following on those. Okay, so that's the earnings side. So this, again, putting this into perspective, we've got this economy which looks all right with the current thing, with all the current measures. All the forward ones are looking bad. We've got the earnings that's started to turn down a little bit, but if it follows these forward indicators, then there's quite considerable downside to earnings. And then you get back to, well, what are prices actually doing? And so have we seen any of this? What looks like a pretty bad fundamental outlook, what are we seeing reflected in prices? And we'll jump into the actual prices in a minute. I'll let Sam, you sort of go with some of the technical side, but I actually just wanted to highlight as well that cyclicals versus defensives is an interesting one in that when cyclicals are beating defensives, and what I mean by that is cyclicals are companies that go through quite big cycles. So it might be a media company, for example, where you go into a downturn and everyone cuts their advertising pretty quickly. And so they actually fall a lot further than the economy. And then when they come out of it, everyone goes from not spending anything on advertising to spending on advertising, and they boom faster than the economy. So cyclicals have actually been performing really well. So this is not the type of environment you expect them to perform well. Coming out of the COVID recession, absolutely. But the last month or two, we've seen this big rally in terms of cyclicals, which would suggest that all these economic indicators are effectively wrong, and that actually the Fed is going to manage a soft landing, and that they'll manage a soft landing, and the economy is going to boom on. And so so that's one part. And then I wanted to talk just about that's one side of the equation. The other side is the actual price movements, and really just looking at that part where what we're really seeing is that things are coming to a head. So depending upon what technical analysis you look at, you can come up with a bearish or a bullish view. Obviously, you know, there's hundreds of different ways to look at this, but the preponderance of people looking at technical charts are sort of suggesting that we're coming to an inflection point at the moment, which is sort of going to either push markets higher or lower. And you know, obviously that's not as helpful, but it is interesting knowing when we are coming to these points. But with that, I might leave it to you, Sam, to maybe discuss some of these technical charts.
Sure thing. So I'll just bring up this chart here. So this is the S&P 500, the ETF SPY, the most liquid ETF in the world. So I'd argue that more people are watching this than the MSCI World Index. That's why I've chosen this one. You can see where we've come. So this is a weekly chart of the last 5 years. So we've obviously had a huge run up in prices. Then this next chart here just shows essentially the same thing, except it's a daily chart. And so what we've got on this chart here is we've got a 50-day moving average and also a 200-day moving average. And in the world of technical analysis, people are just looking at price, so they're not taking into account fundamentals at all, and making decisions based on what the price is doing. A lot of analysts have a lot of different indicators, moving averages, and the like. And so on this one, there's the what's called, well, when when price is above the 200-day moving average, technical analysts are often long, looking for long positions. And then when it's below, they want to be out of the market or short. And so a cross that's used is when the 50-day crosses over the 200-day. That's often a sign of a turning point in the market. You can see here on this chart that most of the time it's going to keep you on the wrong side of the market, but then there's going to be a few false signals as well.
Keep you on the right side of the market.
On the right side of the market.
And it's worth noting that there's a lot of commodity, they call them CTAs, commodity trading advisors, or there's a lot of momentum funds, which basically, they'll all have their own special sauce as to how they do it, but they're largely based off similar indicators. And so I wouldn't say these guys make the market in terms of, they don't determine the overall aggregate level of pricing, I don't believe, but they do affect it very much at the margins in the short term, because what will happen is some of these indicators will go positive. And as Sam says, the price will go above its 200-day moving average. And there's a whole bunch of people who have programmed into their computers, when the price goes over the 200-day moving average, then buy. And then, and then you're predisposed to buy, and now you're looking for other signals to tell you to buy more and more and more. And then when it falls, they're going the other direction. And so, while, you make up your own mind as to the technical analysis, for me, it's saying two things. One is it's worth looking at from a, if there's smoke, you got to look to see whether there's fire. So, price movement might be indicating that things are better or worse than what you might think from a fundamental perspective. But the other part is it is showing that sort of short term. There's a short term rush in and rush out as various technical indicators get ticked off, and there are a lot of people, and increasingly more and more people following these short term indicators, and so that will push the market around in the short term. It just won't be able to hold it for the longer term.
Yeah, excellent. So I'll just jump to this next slide here. This is just a zoomed in slide of the last 3 years daily price. So you can see at the about April 2020, we've obviously got, this is the start of COVID. So and the fastest market downturn in history. And then obviously it bounced back up and had that huge run up. So if you're following the cross of the 50-day to the 200-day, that would have been too late, but you wouldn't have really been out of the market for too long, and then you would have captured all the upside. And then start of 2022, that's when we were in the downtrend. the start of the downtrend. And I mean, in technical analysis, downtrend, it's lower lows and then lower highs. So you can see in that chart there, I would argue the downtrend's still in play. So a series of lower lows, lower highs. And I want to say, this is an art, not a science. And it's very subjective. But if you're following it, you can see that at the moment, the downtrend is still in play. I would say if, the low there of about 350, so this is the ETF, so the S&P 500 is actually at about that low there, 3,500. So just add a zero onto the y-axis there. And I'd say the high to look for if it's going to break is either, I would say 430 or 4,300 or maybe 410. I would say there'd be a lot of activity if it breaks that high there. But I mean, the downtrend's still in play, but we're sort of getting to that point where there's been this consolidation for quite a number of months. And, the bulls and the bears, they're placing their bets. So, people are placing their long positions, people are placing their short positions. But at the end of the day, someone's going to be right and someone's going to be wrong. So let's say it breaks out to the upside. I'm not saying that's what's going to happen. But if that does happen, all the shorts, they're going to have to cover their positions. They're going to have to buy their positions back. And often that adds a lot more fuel to the fire to sort of increase the momentum to the upside or vice versa, depending on what happens there.
Yeah, because I guess is this point is that you can see that right at the end of it, we've got the actual market line converging with the blue line and the red line in terms of all three is coming together. And that's, if there's a decisive push up, that will just flip a lot of people, a lot of the technical traders who literally just don't care what the fundamentals are, but they'll just go, oh, well, that's all the things are pointing, and they might push the market another 5-10% higher. And then on the flip side, if it breaks lower, you might see the people who have been participating in the most recent rally sort of again abandon ship. And so there's another analogy that comes with it that I quite like, is that you've got so these are the traders who are going to determine the sort of short term, and then you get the next phase steps in is where it's the asset allocators like ourselves or other. There's lots of other people out there who do the same thing, and they will be out there sort of tilting in and tilting out of assets on mostly valuation and fundamental analytics. So the market goes too high, they start selling out their positions. Market goes too low, so they're sort of like your medium term holding your market in. And then you've got your really long term ones, which are a lot of I guess high net worths and other people who are basically are happy to sit outside the market completely and aren't sort of benchmarked or anything like that. They're just happy to sit there and do nothing and just sit on cash or other assets. And then when markets get low enough, now they pile in, or when markets get too high, they get out. And so they're sort of like your very long term, coming in to pick up markets when they're particularly cheap or sell markets that are particularly expensive. But it's a mixture of those three. And I guess what we're saying is that the second two, we haven't really changed, but it's just worth noting that first one's there's things going on.
Yeah, and just one other point I want to make is where we are at the moment. If it breaks those lows, a lot of technical analysts work on support and resistance, so areas of previous buying or selling. And if it breaks those, the most recent lows from sort of October last year, looking at this chart, there's no real major support for quite a long way down, so 320 or 3,200. So, I mean, the market could easily go down there because there's no real reason for technical analysts to step in and start buying those areas, whereas previous highs, often they'll step in there with support and start buying there as well. And I mean, another argument from the technical sort of standpoint is at the moment, looking at this chart here, it's just a shorter term chart of the last 2 years. But there's patterns. There's all sorts of patterns that technical analysts decipher from the price movement. And what we've potentially got going on here is an inverse head and shoulders. So you can see the October low, that's the head. Then to the left, we've got the first shoulder that's in. And then right at the moment on the far right of the chart, we've maybe got the second shoulder. And that would, with technical analysis, you never really know until it's happened. So you're working off probabilities and risk and reward. But there might be an argument that this is going to break to the upside. But then, it obviously takes two opinions to make a market. So there's always people on the other side of that as well.
Yeah. But yeah, and the point is, as I said, if it does break to the upside, if it pushes through, we get a confluence of positive economic news, then maybe there's a decent bit of upside. But the flip side is it's an inflection point. Now's dangerous. And the other thing I wanted to highlight as well is market analogies. Now I see these charts floating around all the time. I've got a chart up here just sort of comparing 2023 with 2008. And I just want to caution against it in terms of these ones. So this chart looks, and it's running back from from earlier on this week, and sort of lining that up with the first of with the start of the year in 2008, and with December 2008. October 2008. Try that one more time. And then it runs back and goes, hey, look how these prices moved really similar. And so, the implication is, therefore, this thing's just about to fall out of bed, and it's going to go down another 50% or 60%. I'd caution against sort of drawing these ones. These lines fit together far more than you'd think. Like, you can basically pick any period and you pick any one given year, and you can probably find something that'll line up and give you either a bullish or a bearish or a neutral view, depending upon what you want to do. So I guess the thing I wanted to highlight with these is they look like they're giving you lots of information, but really it's just I feel like it's seeing faces in clouds. These, and or pictures in clouds. You can do it with just about anything on these.
Excellent. So we've got a couple of questions that have been coming through here, Damo. So we'll just field a couple of these. So one from Ben O'Reilly. He is saying the big banks have all projected the trajectory of interest rates. So he's asking, what rate and month do you think interest rates will likely peak in Australia? Have you got a view on that?
Look, it depends on whether you're talking about short-term rates or long-term rates. I think there's a reasonable chance we've already seen the tops in the long-term rates. I think the short-term rates, look, now you're down to how is the Reserve Bank going to read the information, and how they're going to translate that into what they're doing. I think they've done enough and too much already. I think they could easily pause and see what the effects are, and we're still going to see a pretty decent downturn. But I don't have any special insights into the RBA and when they're actually going to decide. But yeah, so I do think there's that's the part where I think as well, trying to second guess that the short-term stuff is not as important as trying to work out that longer term rates anyway, as to when they've peaked or not. I think I do think they've pretty close to peaked. Maybe you'll see the one disclaimer to that is maybe there's what Dave often describes as one more rug pull, where central banks do look at what's called a financial conditions index, and to try and work out basically what it sounds like. What are financial conditions like? Are they tight or are they loose? And one of the things that goes into that financial conditions index is the stock market. And so arguably, how you look at it, when you've had a big rally like we've just seen recently, that actually makes it look as if money's tight, money's easier. And so therefore, the central banks therefore have to do more. And so, and when they come out and start talking about doing more, like we saw last night, that's when we see markets start to fall away. And so there's a bit of a push-pull between that. If markets rally too much, then central banks step in and have to talk about how they're going to raise rates more. And if markets fall back far enough, then central banks can actually ease earlier.
Okay, I hope that gives you some insight there, Ben. And we've had a comment from Philip. He's saying the name of the game is to make a return and prevent large drawdowns. And he's saying here, good technical analysis. You've got to take into account the risk factors. And I think that's to your point as well, Damo. And I just want to say, it doesn't matter which side of the fence you sit on, whether you're all in on technical analysis or all in on fundamental analysis. You've got to have an awareness about what's going on in either camp, because they do have an impact and they do influence each other. And so, I think it is good to take note of what's going on.
And it'll one more measure as to when you might be wrong. That's the main one we use it for. Is that we'll use more quantitative measures for stocks as well as markets. But the idea is that we'll have a fundamental view about a stock and we like it. But if the technicals are terrible and the quant signals are saying you got to be selling this on the price basis, then it's not necessarily it's not something you have to go back and absolutely sell it. But it is worth saying, well, maybe I've got something wrong. I need to go back and find out. Are there things out there that other people know that I don't? Or is it non-market, non-public information that might be circulating that's going to come out soon, and I need to try and be on top of it. And that's often the case.
Yeah, excellent. And Philip's just come through with one final comment saying, follow the Fed funds rate. So maybe that's to the point, don't fight the Fed. Which is a well-known slogan in the investment world.
That's right. And if you are saying don't fight the Fed, then the argument now is not buying equities. That's should be selling equities if you're following that rule at the moment. But
Yep. Okay. So now we've got our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for the week is, are you a technical bull or a fundamental bear, and why? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So now we have the investment implications.
So look, pretty much unchanged from last week. We're still looking at those. We're jumping into reporting season now and starting to see some numbers coming out from the very early reporters, but it's still too early to sort of draw too much. But our expectations are that we want to be longer defensive side of the stocks, shorter on cyclicals. We do think bonds are still looking quite good, and there's been we've seen a reasonable rally in that over the last week or two. And the property bust in Australia, another 6 months to run at least. But then, we're probably looking at central banks starting to look at cutting in the second half of the year as all these factors sort of come through in the first half.
Excellent. Nice one, Damo. So it's a bit of a shorter show this week. So thanks for sharing your insights as always.
Thanks, Sam.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with myself. Don't forget to like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. We do put out a lot of other articles and videos in addition to this podcast. We have our new format, Nuclear or Rapid Insights, which is a shorter version of the podcast, generally between 10 to 20 minutes of insights from around the world. And of course, you can follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next week. Bye for now.